always want to go, what's obvious to me? What's cheap? Regardless of what's popular, I've never chased the popular thing. I've always gone to what's really interesting, what's cheap, and what will cause that at some point to not be cheap anymore, right? To achieve a proper valuation, whether it's a takeover or just a higher multiple. So management is critical. So first of all, we talked earlier about the valuation gap between the middle size and the small. It's big, right? So the ability to pay a premium is there. Check. Accounting. Lower rates means the marks you have to put on a company for loans and securities are less, which makes the merger math better. So rates coming down is really important for all of that. We talk about the average age of board of directors, so that's there. The capital markets are open. What I mean by that is if banks want to raise capital to go on the warpath and buy other banks, they can do it. So my largest position right now is a company called...
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today, I'm delighted to be joined by Anton Schutz. He is the president of Mendon Capital, and he is a specialist in the financial services and the banking sector with a lot of experience in that sector. Welcome to the podcast, Anton. Really great to have you on.
It's a pleasure to be honest. Experience, another way of calling me old.
No, experience is very important in investing, as you will know.
It sure is. I've seen a lot of things in my years in this business.
Yeah. So, how's everything today? The weather holding up today?
Weather's holding up today. No hurricanes in the forecast, so thankful for that.
Great. Great. That's really good. Obviously, it was very terrible what happened in Florida last week. It was a lot of damage, but luckily, it wasn't very close to you. So, we'll count our blessings on that. All right. So today I wanted to do a very special podcast in which we talk about the financial services industry and we kind of do a much more deep dive into what's happening in financial services and a little bit more about the process of investing in financial services. So it's a real pleasure to have someone on with a lot of experience in that sector. As it's your first time on the podcast, Anton, I wanted you, if possible, just to introduce yourself, give us a little bit more about your experience in investing and in banking, and then maybe touch upon what is Mendon Capital as well.
Sure. Well, I used the word old earlier, but experience is a better word. But I've been doing this since 1986, or in and around the financial services sector. I spent 10 years at Chase Manhattan Bank, and among those 10 years were 5 years spent within the regional bank, sort of being the Johnny Appleseed of derivatives in the regional bank. And what that allowed me to do is travel all around the country and meet small banks and see the difference between geographies all over the country. Because this is a great big country, but all those states have different rules and different reasons why people want to be in them or not be in them. And I think that was a real important eye opener for me early in my career. And so when I, really saw the opportunity for a consolidation wave to happen in the financial services space, I founded Mendon Capital Advisors in 1996 and started with a long short effort. And in 1999, I started a mutual fund, which is now today the RMB Mendon Financial Services Fund. And I've also been involved in venture capital and technology for the banking industry. So it's really been sort of interesting as 2020 really forced banks to go, oh boy, we better pick it up. The way we're dealing with our customers is now very different, right? Nobody wants to see another person during COVID, let alone go into a branch. So, it really changed everyone's behavior. And fast forward, all the things banks had to do very quickly from a technology perspective. So we saw that opportunity, and we saw the opportunity to help the banks.
Yeah. All right. And what first attracted you to getting into the financial services sector? What was the main thing that you thought, right, there's a lot of opportunities here in financial services?
Well, as an investor, I saw lots of things when I was at Chase. I saw the industry, I saw, deregulation, and I saw the fact that we had in 1990 with 15,000 banks. And so I was just watching that, and I go, you know what? By 96, I said, I've got to participate in this consolidation wave. And there's going to be lots of it coming. Today we have 5,000 banks. So, we've done a fair bit of the work, but believe it or not, lots more to be done, lots more efficiencies to be created.
Yeah. Yeah, that sounds like there's a lot of opportunities and ways that banks can be more efficient, kind of move into the future as well. So it's a constantly evolving industry. Wanted to ask you a little bit more about your processes and how you go about identifying what are the best banking opportunities and maybe some differences between the regional banks and the more national or international banks, and how you go about that process of saying, look, I think that this bank is the best opportunity to invest in, and what type of things do you look at?
So, boy, that question, I guess we ought to have a 20-hour podcast, right? Um, there's so many things that go into it. Um, but you know what? You really start with the people at the top of an organization. And so managements are really important. Now, obviously, the fact that I do financial services means I can invest across the space. But, I always want to push the easy button, right? I always want to go, what's obvious to me? What's cheap? Regardless of what's popular, I've never chased the popular thing. I've always gone to what's really interesting, what's cheap, and what will cause that at some point to not be cheap anymore, right? To achieve a proper valuation, whether it's a takeover or just a higher multiple. So management is critical. There's no doubt about it. And having spent a lot of years in this space, I've seen a lot of people, and I've seen people I would never invest with again, let alone invest with for the first time. I've certainly been fooled before. I'm not perfect by any means. None of us are. But if you fool me once, I don't think I'm going to write you another check and invest in your company. But reputation is everything, and that's just critical. Look, a lot of bad guys got taken out during the great financial crisis in 2007 and 8. People who were not good or people who had bad intent. So the industry sort of got washed out. There's a couple of people out there. I won't name them on your show, but I'm not going to invest with them. They're just, they're not to be trusted with the accounting, right? Accounting is one of those things, let alone trusted with making proper credit decisions, because this is still an industry where you have to make a proper credit decision. And that's really important. I know there's one fintech out there that says, oh, we're proud. We don't have any bankers on our team. Well, you know what? You got 10 years of data, and that's not enough. You want lots of years of data, and you want lots of experience, and you want to know your customer. And so when you try to mass market things with a financial model, it's not the same. It's not as good. And that old relationship model where you know your customer, it's critical. And if you've been through a tough time before as a chief credit officer, great. You know what can hurt you. And that's really important. So, I think those management teams that are battle tested are really important to me. And then on top of it, geography really matters. I brought it up earlier. When you look at the advantages and disadvantages of various places in this country, that matters, right? Are you pro business? What's your tax structure? Do people want to live in your state, beyond just that pro business and tax structure issue? So, one of the, and ironically, we have a strike at the ports today, but one of the things that excited me, a decade ago, were the Southeast ports taking market share, building new ports, improving them, creating lots of flow. Places like Greenville, South Carolina, it's not even on the ocean, but they're getting a lot of the flow. They've built an inland port that's coming out of Charleston. So places like that have just boomed and done very, very well. And people have migrated to those climates, right? South Carolina is not a zero tax state, but people want to live there. And corporations have wanted to live there. They've attracted all sorts of, companies like BMW and Michelin. And, these cities have really grown. They're not giant, they're not household words, but the banks in those areas have thrived because what sprouts are up around a new business? Lots of business activity, small businesses being formed to service it. people building homes. It's really important. So those demographics are absolutely critical. So you want a good management and you want to be in a place where there's good demographics. Now, why would I invest in a place where the demographics aren't perfect? You might have disruption, right? We talked about mergers and acquisitions. Well, you might have a market where, a company like a Wells Fargo, for example, right? They've had an asset cap on them. And because they've had an asset cap, they've not been able to grow. So what's happened to, enterprising young people at Wells Fargo? A lot of them have gone to regional banks, right? Because they said, all right, well, I can go to a place that's growing. Now, Wells may be able to grow in the future, but that was helpful for the industry, for the smaller banks. Truist, the merger between SunTrust and BB&T was really helpful for small banks because they cut a lot of people and a lot of customers moved, a lot of people moved. Again, opportunity for the industry. So it's not always going, hey, the geography's better. Sometimes it's just the opportunity that's been created. You've got a lot of disruption that's gone on in California, right? You've had US Bancorp do a very, very large deal. And again, that's created a lot of disruption, a lot of customers moving. So smaller banks have benefited.
Yeah. Yeah, it's very. I can see how it'd be very important to get an area with growing demographics because it means there's much more business in that area, more room to grow, which obviously will be good for the bank. How important is the bank's balance sheet when you're assessing these stocks and these opportunities in banks?
Sure, really, really important. All right, so let me backtrack a little bit. A lot of the industry gets valued off of book value, right? Now, some of that really comes down to things like return on equity, return on assets. And generally, if a company trades below book value, it's going to have a low return on equity and a low return on assets. So sometimes it makes sense where companies trade at a discount. PE ratio is another thing you look at. That's important. So the balance sheet, as you asked before, now is something that's created that earnings stream, right? That management team is taking that balance sheet, created that earnings stream. What's different? What changes, right? The Fed's just lowered interest rates. Do you have a balance sheet that is actually sensitive in a positive way to rates going down? So that's called liability sensitive. A company that makes more money when rates go up is called asset sensitive. So that's important to the process as well. I don't immediately shift on a dime. I mean, I think I last time I did it was back in 2001. Sadly post 9/11, but I said, oh wow, the Fed's just got to cut rates like crazy. Let me buy everything that does mortgages. Of course, the Fed got everybody in trouble by being too aggressive for a number of years. But sometimes you see it and it's that obvious, and you shift towards a business line that's going to really benefit from what's going on. Now, I will tell you that going back to the mortgage comment, what's gone on over the last few months, right? Rates have come down tremendously. The refi wave has started. The mortgage business is not in anybody's estimates for the banking industry. They're all talking about margin and interest rates and what rates are going to do, deposit costs and loan yields. But I've seen nobody increase estimates because of the mortgage business. And that's kind of great, right? Because that means estimates are too low for the industry. And it may not be this quarter or next quarter, but over the next few months, you're going to see companies start to ramp up that business and it'll start to show up in earnings. So I love sort of having an aspect like that no one's really focused on, that is now kind of obvious. Everything I've seen from the Mortgage Bankers Association and their forecasts for new origination and refi, those are pretty big numbers. So banks that have not gutted that part of their business, and most of them have not. Some have cut costs, but some are building businesses, and some of those are building businesses are really going to be poised to make some money, and that's in nobody's estimates.
Yeah. How do you feel about valuations at the moment of these regional banks?
So it's really interesting when you talk about size, and the largest banks trade at much bigger multiples to earnings and price to book than the smallest. Now, part of that is driven by liquidity, right? If you're a generalist portfolio manager at a very large shop, let's, for example, say BlackRock or Fidelity, and you want to be in the banking space, what are you going to buy? JP Morgan, Bank of America. You got to reach for stuff that's liquid. You're running a large portfolio. So, the little guys get left behind for a while. Liquidity will eventually find them. And if money starts to flow back into small cap managers and the small banks perform, and they will, and the reason I say they will is that gap between the mid cap banks and the really small is pretty large on a valuation perspective. So you've got multiples in that sort of 1.7 times book value for mid cap banks, and you've got banks below a $250 million market cap trading below book value. So the math is very simple. You could pay your own multiple for a target and make it, with cost cuts and everything, make it pretty accretive. So what that means is you could wake up any given day and get a pretty nice pop on a takeover announcement. So, I would say half my return over my career has been made from M&A. So that's been really important to how I create return over the decades I've been doing this. And my favorite kind of bank is not one that you go, oh wow, that bank's got to sell. Sometimes when you say that bank's got to sell, it means it's not the best bank, right? It's not in the best of shape, it may not have the best management or best geography. But if you've got a bank that everybody wants because it's good, it's in a great place, and by the way, it's doing a nice job running itself, I don't care. I mean, my investors don't care either, right? That stock is going to work one way or another. It's either going to go up because it's doing a great job, or one day I'm going to walk in and have a very pleasant surprise. And, the only thing I could say about that is sometimes I miss the management teams that sell those banks. You build great relationships with them over time. And, but at the end of the day, it creates return. A properly structured deal is a win for both sets of shareholders when the buyer doesn't overpay.
So would you say that the regional banks have a much better risk to reward ratio at the moment because obviously they are priced a lot more cheaply and better value, as well as having the potential to be acquired and give you merger and acquisition type returns?
Exactly. I mean, we're in a spot right now where things are, looking like the potential is very good. Now, the other thing that's really important about the Fed lowering interest rates isn't just the margin of the banks. What it does is it makes everybody who borrows money better able to pay their bills, right? Whether it's the consumer or whether it's a real estate borrower. And I think that's been one of the most frustrating things when I talk about real estate. If you look at major media and the people they've put on and the people who've talked about thousands of banks failing because of commercial real estate. Do you know how many banks have failed in the last, since Silicon Valley because of commercial real estate?
I'm not sure. Maybe you can enlighten me.
Read my lips. There's no movement. There's no movement, right? The number is zero. So why don't you bring those guys back on the air who said that 2,000 banks were going to fail? I mean, all they've done is scare people out of those stocks. And it's really sad, when those people get a bully pulpit and get to be able to speak about stuff like that. Because, you know, do the work, right? Get out there, go talk to people. When I go talk to my smaller cap regional banks, I talk to them about their process, their lending process. What do they have? What's their exposure? And the vast majority of them might have a 1 or 2 story building that's called office. And what's in those 1 or 2 story buildings in the suburbs? Doctors, dentists, they can't work from home. That building's occupied. And, they're going to pay the rent. So at the end of the day, that kind of property is not going to become a loss. If you go into some of the coastal cities where the larger institutions have some exposure, and again, it's not a big percentage of their balance sheets, not the kind of stuff that's going to cause them to fail. Yeah, San Francisco, not so great. Boston, not terrific. Washington, D.C., nope. New York City, yeah, it's got some issues. But, you go down to Nashville, Tennessee, or even Miami, where there's a lot of growth, as we talked about earlier, even the taller buildings don't have those issues. So it's where it is, it's who's doing the lending, it's the type of structure. It's really important. I mean, it is technical, but I'll give you an example. Let's take a bigger bank. Let's take a PNC bank, right? That's a big bank. It's almost national. It's a very well run bank, but they have some exposure to some of those cities, some of those loans. Now, what have they done? They've set aside very large loan loss reserves, over 8% reserves against office buildings. All right, well, if they lent originally at call it 50% loan to value, and now they've put aside another 88%, now they're at 42% loan to value. because they've already taken the hit on the 8% they put in reserves. That means the thing's got to be down over 60% for them to even have a dollar of loss from here, right? And by the way, the average at the large regional banks in terms of office, it's 4% of the entire portfolio. Not going to take somebody out of business.
We have just do a little recap about what happened during that Silicon Valley bank collapse and some of the worries around regional banks at that time. Could you just give a little bit of a recap on the situation that happened and how it's evolved since then?
Yeah, no, it's fabulous to go back over that because not that I saw failure coming, but I didn't like the investment thesis behind Silicon Valley. I didn't like the investment thesis by any of the guys that failed. And the reason I didn't like it, and again, this is paying attention to little things. You asked about balance sheet earlier. What's funding look like, right? What do their deposits look like? And when you have very large concentrations in one group, and in particular in Silicon Valley and First Republic and PacWest and even Western Alliance. Now PacWest and Western Alliance didn't fail, but people, wanted them to, I guess, were betting against them. But they had very large concentrations of deposits to venture capitalists. So to sit there and say that money is sticky, no. I mean, I've never believed it. I heard it for years from Silicon Valley management. Oh no, those guys would never leave. Well, I mean, Peter Thiel sent out a tweet or a text or whatever and got them all to leave. And that is something. I will also say that capital raise, I was shocked at how poorly it was not executed. Right, it never got executed. But when I realized that I didn't get a heads up on that capital raise, that it was announced to the world that here it is. I'm like, oh, you never do that, right? What you do is you take a bunch of institutional investors over the wall, right? You sign non-disclosure agreements and you go, okay, now I get to look at what's going on, but I can't trade your stock. I can't talk about it. And so when they talked about the bond restructuring, they said, okay, yeah, I might be willing to buy some stock at a big discount because this is a nasty hit, but you're still in business. Now, when you announce to the world you've just taken a giant loss and you don't have the money in the bank yet to pay for it, bad idea, right? Because you allow the bad actors to go out and short your stock, at will, and you scare everybody who was going to write a check, which is what happened. So, we just saw a capital raise recently where the bank said we're going to restructure our bond portfolio, but we're not doing it until we have the money in hand. Yeah, that's the way you do it. So that was a shame. It created the domino effect, right? Everybody started going after the other guys. The venture capitalists got nervous. They started pulling their deposits and going to the biggest banks, going to JP Morgan. And, it created some real stress on the system. It also woke up every investor on the planet to go, wait a second, what's my bank paying me? And what's my insurance? What are my insured deposits? And again, there are lots of stuff out there from an education perspective, right? You know what the FDIC guarantee is? It's $250,000, right? Did you know that if you had an account with your wife, it's 500? Did you know if your two kids were on it, it's a million, right? It's 250 per, right? Does anybody actually know that? No, nobody knows that. The other thing that drove me nuts, and the shorts did this, is they went after every bank and said, okay, what are the accounts over 250,000 that are uninsured? What does that look like? Well, a lot of deposits in the banking industry, particularly the regional banking industry, are for municipalities. And if a municipality is going to put a big deposit at your bank, what do they ask for in return? Collateral, usually US Treasuries. So, no, they're not insured, but those deposits aren't going anywhere because they're collateralized against probably the best assets you could do. So again, a lot of people sat there and said, "Oh my God, these banks are all going to fail." Not going to happen. And look, I wish the FDIC had created a higher deposit structure or a simpler one. We've had inflation since they last raised it to 250, but what they did do is pay everybody back, right? Well, there was a Silicon Valley or First Republic, didn't matter what size, and that should have given people faith in the banking system. I also think that the long-term funding facility the Fed set up was brilliant for anybody that wanted to go borrow money. It didn't matter what their basis was in the treasuries. they lent them against the face value. It really helped alleviate a short-term liquidity squeeze because everybody was feeling it. But I will tell you, most of the small banks really didn't. And it's interesting as I went and called all the CEOs and said, "Okay, guys, what's going on?" And oh, well, we're driving around all our parking lots. They seem pretty quiet. And that's a small community bank. They know their customers, and those customers, there was outreach to them, and I think that was really important. And people got a chance to understand that their bank was fine, but it created a lot of unnecessary fear the way it all went about. It's really sad that happened that way. People lost their jobs. Um, if I were the regulators, I mean, I think they've learned a lesson because bad interest rate management is, you know, it's going to take down obviously banks. I mean, they're so worried about credit that they lost sight of good asset liability management policies at banks.
You mentioned during that kind of crisis or during that time, there was a lot of people moving over to the larger banks because they were worried about losing the deposits before it was backstopped by the government. Have you noticed since then, has there been a flow back to regional banks since then? Have you got a kind of an eye on that?
It's fascinating. By the way, it was all temporary. I mean, it really was temporary. I will tell you this, that the borrowings of the smaller banks in this universe, they are borrowing less money from the Federal Reserve or Federal Home Loan banks than pre Silicon Valley. Guess who's borrowing more money from those entities? The big. Fascinating, right? I mean, it's counterintuitive from everything you hear and read, but deposits are back. They trust their institutions. And, I mean, it all worked. It created quite a scare. But at the end of the day, the process worked. And look, I give the FDIC credit. You know, I mean, yes, it's moral hazard by backing those deposits, but it created calm in the industry.
Yeah, it certainly did because there was a lot of worries before then. And once that happened, it seemed to kind of alleviate a lot of those concerns. How obviously recently we've just seen that the Federal Reserve have reduced those interest rates by 0.5% at the last FOMC meeting. How sensitive are the banks to interest rate cuts at this juncture? And what type of differences do you think it will make in the short term and then kind of moving into the long term?
So, when you're running a big balance sheet, a bank balance sheet, there's nothing worse than sudden moves, right? 75 basis points, time after time after time going up. Hard to manage that. If you've got fixed rate loans, when that happens, that's not so good. And obviously, after Silicon Valley, everybody's worried about what they're getting on their deposits. So it created this rush and pressure. I will say, even prior to the 50 basis points, banks have started to cut special rates. Rates started to come down. Even on the lending side, right? LIBOR, not LIBOR anymore, but the cost of funds for banks had come down dramatically for borrowers because those spreads had come down. Everybody anticipated a Fed cut and continues to. So borrowing costs have come down. The banks are trying to be very proactive on lowering deposit costs. Ironically, the banks that are the best at the deposit game don't win as much on the way back down, right? Because they can't cut the costs. The banks that are the worst, which I would call liability sensitive, actually are going to benefit the most. So you're not going to see any impact to this quarter, right? Because it's a few days, but you'll see impact in the fourth quarter, and you'll start seeing some banks. I mean, there'll be a really real bifurcation. Some banks will post much better numbers, and others will start posting worse numbers. For instance, Wells Fargo, we talked about earlier, they are asset sensitive. So when rates come down, their net interest margin actually goes down.
And obviously, recently we started to see delinquencies go up on some loans as the obviously rates were high for quite a long period of time, and people used up their savings and started kind of maxing out their credit. How big of a risk is delinquencies on some of these, I guess, smaller regional banks?
So very, very little issue in the banking sector. I'd say it's a much bigger issue in the consumer finance companies. Ally most recently warned about having some credit issues. So depending on which level of customer you're doing business with, the lower end is having a harder time. Inflation is taking a bigger bite out of their savings, out of their, even if they have jobs, out of their income. So they've struggled. So I think there's risk there, but I would say it's not in the banking system. It's more in consumer finance companies. Obviously, rates coming down takes pressure off of some, but you need them to come down a bunch more to really, go, all right, are we really stimulating that sector versus giving them a little relief? Um, from a delinquency perspective, I'd say it looks to me like we're pretty close to the peak in the banking industry in terms of non-performing loans. With credit formation. The ones that I know of, the small banks that have had stuff that they've had to sort of get their hands on, a piece of property, a piece of real estate. A lot of them are being marketed, and many of them are going to be sold without any harm. So, I think ratios will come down next year. Again, part of it's up to the Fed, right? Part of it's up to, who we elect in November. Are they going to hurt the economy? Are they going to help the economy? And, there's a lot of pieces we don't know, but at least from what we do know, it appears the industry is in very good shape from a credit perspective. Again, we talk about commercial real estate has not done the damage that people forecast that it was going to do. And there's lots of funds being set up to buy that distressed commercial real estate. So, I think there's a lot of liquidity out there still in the world. And I think that's a good thing.
Yeah, yeah, certainly is. And do you think at the next big bank earnings season, do you think that that will be quite a vital barometer of what's happening in the overall economy moving forward? Do you think it will be a big sign of whether a recession might be on the cards and the general health of the economy?
You're not going to see anything too negative from the banking system on this earnings season. You're not going to see too many big changes on interest rates. Like I said, the Fed cut just took place. It's going to be the fourth quarter. It's going to be more interesting on the interest rate statistic. And again, we've had a chance to listen to a lot of these banks at conferences over the last few months. Obviously, they're all quiet now, but yeah, there's nothing that I see on the horizon that would concern me from a credit perspective.
That's good. Okay, and is there any banks or any regional banks that kind of catch your eye? Obviously, at Mendon Capital, you're invested in lots of different financial services companies. Obviously, this is not financial advice. You're not telling people to go out there and buy anything. But can you just talk a little bit about the opportunities in the market for financial services and companies which you're interested in, and perhaps why you're interested in them?
Sure, sure. Look, at the end of the day, the easiest names to talk about, and obviously we own them in the mutual fund, right, which is my biggest entity. It's all public that I own them. Um, and look, I think from a compliance perspective, what's always critical, and people go, you're talking your own book, is how you behave when you talk your own book. That really matters, right? So if I sit there and talk about a name, and I'm going to, that means I'm going to own it tomorrow, next week, next month. I mean, I think the last time I called the compliance guys and said, oh, by the way, I've talked about something, but it's up 30% since I talked about it. I just want to trim it a little bit. So I just want to make sure you're good with it. And that was weeks later, right? So it's really important how you behave when you talk about your positions. And my biggest positions have been my biggest positions for quite some time. I've gotten to know these managements and their geographies and their practices. So I'm giving you the whole setup into it. Um, so my largest position right now is a company called Equity Bank, EQBK, in that hotbed of Wichita, Kansas. And, basically small towns, lending to manufacturing companies, lending obviously to the people in those towns. And I think their average deposits are somewhere around $10,000 a customer. So, they've been a high performing bank. Why have they been high performing? Well, conservative culture, a lot of insider ownership among management and the board. And one of the things that they've benefited from is being a consolidator. They've bought many little banks in and around their footprint at very good prices for their own shareholders. And they're going to keep doing it. I went to their analyst day, and you could find this in notes from the people who cover the company. They talked about 900 banks being potentially available in their markets, right? Just size wise. And when you have that, that means you can be opportunistic, right? Not all 900 are for sale. There's always a few for sale at any one time, and you can find the one you like the best at the best price and execute. And they're very good at it. And I expect them to continue to buy banks and to grow their company and do it in a way that's good for their own shareholders. So yeah, there's a good reason. It's my largest position. Part of it's just because it's performed well too, right? It's not just because I just went and bought a ton of it. I bought a bunch of it and it went up a lot and it's kept going on. Now it's always important to look at your positions and look at valuation and go, is that fair? And I look at that stock and I go, yeah, it's still fair because they keep adding to their earnings growth by buying other companies. So really important. My second largest position is a company called Primis, which has a funny symbol, FRST. I don't understand you know, why the symbol's so different than the company's name. But I will say that the CEO, Dennis Sember, is a real entrepreneur. He helped build Ameris Bank, which has been a very successful bank in Atlanta. Primis is a little over $3 billion in Richmond, Virginia. But they've built a couple of businesses, both at Primis and in conjunction with a fintech called Panacea, which lends specifically to the medical industry. And Panacea has been very successful. So they've had very good loan growth and deposit growth there. They've done very well with building a mortgage business. We talked about this earlier. And, the earnings estimates don't reflect that business cranking out a bunch of earnings. So if mortgage refi and purchase activity picks up, they're going to really benefit a great deal. So there's two businesses there. The stock actually trades below tangible book value. They've got a bunch of bonds on their portfolio, which have improved meaningfully in valuation this quarter. I think the average bank is going to have at least 6% growth in book value this quarter. And part of it's just because of the improvement in rates and what they own in their bond portfolio. So their book value goes up, their equity ratios go up. It allows them to do lots of things with that capital. I would expect at some point Primis will hopefully buy back some stock. Now, why is the stock so cheap? It's had an accounting issue, which seems pretty self-explanatory when I've gone through it. But they're either one, going to live with that accounting issue, or two, restate it and bring it back. I mean, but either way, future earnings aren't impacted, and this company's going to earn a lot of money. It's cheap on earnings. It's below tangible book value. I think they'll buy back stock. And like I said, Dennis is an entrepreneur. When I talked earlier about companies having optionality, I like him as a CEO. I think he does a great job, but I also think he has a franchise that other people might want. So, I think that's a perfect kind of position for me. And if I go back to equity's got the kind of bank that others might want as well, and maybe a CEO that other people might go, you know what, he could be in my succession plan. Because one of the things that's happened in this industry is people have gotten older, and because there hasn't been as much M&A activity really since 2018, you've got an average age of board directors that's gone up 6 years. So you got a lot of companies that are ready for sale, and you've got a lot of management teams that are older and they need some succession. So they're either going to sell themselves, they may buy their successor. Very few people just hand the keys over to somebody new, right? You miss out on all the candy if you do that.
Definitely. So can you see merger and acquisitions? Can you see them ramping up over the next couple of years? Because it's obviously been at a low level over the last couple of years.
Well, it's really obvious, right? So first of all, we talked earlier about the valuation gap between the middle size and the small. It's big, right? So the ability to pay a premium is there. Check. Accounting. I know we're not trying to get technical, but this is important. Lower rates means the marks you have to put on a company for loans and securities are less, which makes the merger math better. So rates coming down is really important for all of that. We talked about the average age of board of directors, so that's there. The capital markets are open. What I mean by that is if banks want to raise capital to go on the warpath and buy other banks, they can do it. There were two very successful capital raises last week. One raised 150 million, another raised 100 million, and that was to restructure their bond portfolios. When I got a phone call from one of the investment banks saying, "Hey, I've got a deal," and I go, "Is it for acquisitions?" They said, "No, it's to restructure bond portfolio." I said, "Darn." I said, "Don't worry, we got more coming for you." Okay. I don't need to know who. I'm happy to hear there's more activity coming. And I'll tell you the few deals that we have seen announced have been pretty well received. The markets receive them well. They've not been gigantic. The regulators have been tough, right? So, I think they're more likely to let smaller deals happen than bigger deals. And I get that. But I think that, again, what happens in November can matter. I don't think it matters who's president. I think we're still going to have a huge pickup in M&A activity. We might have more under an administration that rolls back, a lot of the rules. There's a lot of rules out there, and it'd be a lot easier to get deals done with less rules. So it's just kind of that simple. But I think you have a ton of deals that are waiting to get done simply because of the math and because of the age of managements and age of board of directors. It's just too logical. And by the way, when you get those cost cuts out of buying another company, that money is not all just going into earnings, because we talked earlier about technology. They've got to spend, right? They've got to improve their interface with their customers. And technology is key to all of it, right? It's important to use technology to communicate with your customers. It's also important to use that technology to vet your customers, right? To eliminate things like digital fraud, to eliminate things like money laundering. A lot of that gets solved by technology. And, I think as AI comes about and gets better, it'll be really helpful to the industry. We've talked to consultants in the industry from people like, firms like Deloitte that have talked about the cost of banks literally coming down 10 to 15% to run their institutions simply because of what AI is going to be able to do. And it's enormous. Now it's not open AI. Regulators don't want that. Nobody wants that. You've got to have AI internal to your own systems, working on your customers, on your transactions, and seeing what's going on. But if you take JP Morgan, for example, which uses AI in their credit card business, it's pretty simple, right? If they know that you just bought some groceries at your local hometown supermarket, and all of a sudden there's a charge from Vancouver, Canada, when you live in Florida, that's a machine, right? It's not a person making that decision, turning that transaction down. That's like that. It knows. And I think, that is absolutely saving, companies like JP Morgan and their customers from lots of fraud already.
And you've already mentioned some of those points about technology changes in terms of the banking. I just wanted to, as a last question, ask you more about how you see the banking sector evolving over time, how it will use this technology, but just the general structure of the banks and how you expect it to change. Do you expect it to have less employees in the future and rely more on technology?
Yeah. I mean, look, you've got a dock workers strike going on right now, right? And one of the reasons they're striking is they don't want technology to take their jobs. The banking industry and every industry that's operations intensive will have less employees, just the way it is. Um, I expect the technology use to continue to grow. We talked about AI and what that'll do. Branches, you know, our kids today, are they going into branches? I mean, very little. People still want a little bit of human interface when there's a problem, but otherwise, everybody's gotten used to it. Now, people can sit there and go, "Well, JP Morgan's opening branches." Yeah, but they're doing it in a very smart way. Why are they opening branches? They're following their customers, right? They've got auto customers, credit card customers, and mortgage customers right in those places they're opening the branches. So it's not a, "Hey, we're here, let's get some customers." It's like, we have customers, let's service them better. And by the way, they're also closing branches in places that are not as good. This industry will have a lot less branches. Maybe we'll have more Starbucks, I don't know. But those corner lots are worth a lot of money, but maybe not to the banking industry anymore. You're still looking at innovation. You're still looking at smart, small things. One of my favorite bank stories didn't involve technology, but involved in being smart on how to service the customers. The bank was trying to shut one branch and keep one open. They had a lot of Amish customers. Well, there was a bridge involved in the one they wanted to keep. They don't like bringing their buggies across the bridge. What do they do at the new branch? Put in a watering trough and a hitching post. They kept their customers. That same bank had a branch in Lake George. I don't know if you've ever been to Lake George in upstate New York, but it's really busy in the summer. And customers had a hard time getting to the branch. It's right on the lake. What do? Put in a dock. I mean, that's not technology. That's just being smart and servicing your customers. But again, you can use a lot of technology to help your customers and help solve their problems. And I think the most important thing I view as technology is that human touch is still critical, right? If it's all technology solving your problems, most people aren't happy with it and won't be happy with it. If it's a combination of a person and a friendly face, and maybe that same person, that relationship, that's real. So I think you'll see a lot more combination of technology and people and just being able to service customers better.
What about the differences between kind of your more traditional banks, whether that be regional or national, and some of these new, what we call them, fintech banks that are popping up, like SoFi and other of these fintech banks? What is the main differences between these type of business model?
Well, first of all, the ones that have popped up generally don't have a very good advantage in cost structure. And so, when you think about that, the ability to get great deposits at low rates still rests with the traditional banking system. And when stuff starts going wrong and you rely on the capital markets or more wholesale funding like CDs, your customers run, right? We saw that obviously with Silicon Valley, but when things go wrong, let's say you specialize in lending to money with low FICO scores, and you've got a bank you've set up. When credit starts going bad, right? If we have a real recession, how successful is that strategy going to be to either sell those loans or do a securitization or even get deposits as people get worried? So, you know, I think those are neat models. I think they've taught a lot of people a lot of interesting lessons about lending and some not so good lessons. I think we'll see some have some problems. Um, but I think, competition always makes things sharper. And look, if you look at private equity getting into banking, again, it's a little bit of adverse selection. What I mean by that is, why are you going to go borrow money at 7 or 8% when your bank will lend it to you at 6? You're just a little worse credit, right? You're a little more of a story. And if credit, you start getting into a recession, that adverse selection comes back and bites you. And that's a challenge. So, look, I think the banking industry will continue to evolve. I think companies that are non banks don't have that funding advantage. And that funding advantage, the FDIC guarantee, and that history with customers is critical to being able to stay in business. I go back to Capital One, right? Capital One has done a pretty good job of being a bank, right? They're still a big credit card lender, right? That's still their main business. But they bought two banks. They bought Hibernia Bank, they bought North Fork Bank. And when 2007 and 8 hit, the fact that they were a bank helped them survive. It was critical. If they were just a credit card company, didn't have those banking deposits, they wouldn't be here today. So I give Fairbanks a lot of credit for being a visionary and understanding that some of that old bricks and mortar traditional banking, is still part of the future, even though his company's been very innovative.
Yeah, you need that kind of diversification and the overall health of the bank, especially during those hard times. All right, that's some really great insights. Thanks, Anton. And also, how can people find out more about you, Anton, and also find out more about Mendon Capital as well if they wanted to find out further information?
Sure, I think RMB has a website. They're the ones I sub-advise my mutual fund for. The symbol on the fund is RMBKX. So hopefully people can find RMB and do some work there if they're interested in potentially investing in the mutual fund. Um, and I've just recently begun an association on my other products with a firm called Hurricane Capital. Hurricane's not a great word these days, but the Miami Hurricanes, and They've got offices in New York and in Florida, and they provide an operational platform for my other funds. So I'm kind of excited to work with them at this point in time.
Is there a minimum capital requirement or minimum investment requirement?
Well, for the private funds, I would suggest they contact Hurricane. Again, it's accredited investors, and the advertising rule. I guess I'm old fashioned. I kind of don't do a lot. Thank you for trying to help me. But my public face is more the mutual fund, and obviously, if you're an accredited investor, I would contact Hurricane.
Excellent. All right. Thanks, Anton. It's been a really interesting discussion today. I think we've covered a wide array of topics. It was really interesting to get a look into your mind about what the type of investments that Mendon Capital make and the overall health of the banking sector. So I really appreciate that. I think that the audience will get a lot out of this discussion. So thank you very much for your time today, and I hope sometime in the future you can come back on and we can have an update on the latest of what's happening in the financial services sector.
That sounds great, Stephen. It's been a great pleasure. Your questions were well targeted, and I think hopefully people have gotten a better understanding of an industry that I think has gotten bloodied by a lot of reputation and comments, and yet the ability to make returns over many decades has been there, and I expect it to continue to be there.
This is an education channel, so invest education channel. So I think it's important to cover all different topics, and banking is one that's fresh in everybody's mind. So thanks, Anton. Until next time, thank you very much.
Thank you. Be well.